Global central banks have embarked on a new easing cycle. The US Federal Reserve captured most of the headlines with its rate cut. But a broad range of central banks around the globe either moved before the Fed or are poised to cut rates soon. Central bankers have explained to investors that insurance against a recession is the main reason for rate cuts. Business confidence indicators have weakened, mainly in the manufacturing sector, and due to the heightened uncertainty around trade. There have been lagged impacts from the rate hikes in 2018 and from the end of the growth boost from last year's US tax cuts. The ratcheting up of tariffs announced by President Trump on August the 1st really took the markets by surprise. The renewed and more forceful escalation of the trade conflict came after a disappointing meeting between the US delegation and Chinese negotiators in Shanghai. The 10% tariff imposed on $300 billion of US imports from China is by far the biggest tariff increase in terms of impact. It will have a direct negative impact on growth and further indirect effects through sentiment. The recent global deterioration in business confidence should continue and will affect export-oriented economies such as China, Japan, and Germany even more than it affects the US. With the latest move, global recession risks increase and investors will look for safety. Despite their low yields, government bonds and highly rated investment-grade bonds should rally further. The Fed and the ECB can easily cut rates in September if they see weaker conditions. The rate cuts do provide some cushion for markets, since low inflation allows or even pushes central banks to ease policy to allow their economies to grow faster than what was previously thought. Over the past 5 years, central bankers have worried that their exceptionally easy monetary policies would lead to an inflation surge, but that risk never materialized and inflation has remained lower than most countries' targets.